Okay, why don't we get started? Good morning. Thank you all for joining. My name is David Lowe. I'm very excited to be taking over as chair of the Arroyo Virtual Seminar Series Committee for 2023. I want to extend my sincerest thanks to Ava Steiner, who had this role for a while. She did a fantastic, amazing job, and she's given me giant shoes to fill, and I really hope I come close to filling them. So today we're going to have Joseph Nichols from the Federal Reserve Board presenting dry powder versus inside information, the role of out-of-market CRE investors. We're going to aim for about an hour-long seminar with maybe 55-minute seminar with another 15 minutes of Q&A after. Feel free, you should all be unmuted. If you're not, let me know. You should feel free to unmute yourself and ask questions directly. Or also feel free to type questions in the chat, and either Joe or his co-author, John Craner, who should be joining, can respond. Without further ado, Joe, please take it away.
Thanks to David and for Arua for the opportunity to present. This is joint work with the aforementioned John Craner and also Junlin Kim. I also, of course, have to start with the disclaimer that the views expressed here are only those of the authors and not of the Federal Reserve System. The main motivating question for the research, this research paper, is to explore how do CRE prices and quantities adjust to shocks. Like the textbook prediction is that asset prices should instantly adjust to reflect news about fundamental values. So in equilibrium, the asset prices will balance supply and demand, and no one wants to trade. In reality, of course, trading volumes will fluctuate substantially over time and in different states of the economy, and do so differently in different markets. As a simple motivating chart, here's just a simple chart from the MSCI RCA transaction data for commercial real estate properties over time, showing that there was a huge drop in transaction volume during the Great Financial Crisis, and then a subsequent recovery in terms of transaction, and then as we get closer to 2020, another decline. A lot of what we're going to be doing is looking in particular at this role of capital flows around this Great Financial Crisis and how it interacts with some of these changes in commercial real estate transaction volumes. So again, in reality, when there is a shock to a market that creates trading opportunities, for them to actually be executed, you need participants in the market with both the information and also the capital to exploit those opportunities. In Duffy's 2010 paper, he points out that in some markets, capital can arrive very quickly, such as electronic financial markets, and sometimes much more slowly. The example he had was catastrophe insurance. Commercial real estate is often characterized as having a very slow adjustment process. You have large properties with a lot of idiosyncratic aspects to it. It can be somewhat sticky and be somewhat slow to adjust. One of the importances of understanding these dynamics is to also get a better understanding of how fire sales operate in asset markets. So how do you have price discovery when you have a market in free fall? Where does that come from? How does this interaction about the need for capital and the need for information to efficiently execute with that capital matters? So just a quick summary as to why might there be frictions to capital flows in commercial real estate markets. Specifically, we're looking at two different aspects that could be causing it. The first being the information asymmetry story. This is the inside information part of the title of the paper. This is the idea that's been studied extensively by a lot of folks about that local knowledge of a market provides significant information advantage to a potential investor. That there's asymmetric information involving the property quality that the in-market investors, people closer to the property, more familiar with the market, more experienced in the market, are aware of, and the out-of-market investors who are new to the markets may not be as equipped to judge the actual true value of it. The way we're going to try to argue that this interacts in terms of the bidding strategies we see between in and out of market investors is that this means that while both types of investors potentially are subject to a winner's curse of overbidding for a property, out of market investors are actually even more exposed to that because they have more uncertainty around the property value because they lack this informational advantage, this inside information that the in market investors do. There have been many papers looking at this. David Ling in particular has one showing that investors that are more than like 15 miles away from a property have a tendency to overpay for the property because they lack this information insight. The other channel, which we're going to be talking about, is the collateral constraint channel. This is the dry powder part of the argument. The argument here is that when there are sudden declines in local property value, so there's a shock to a given market, that's going to actually constrain the investors that are exposed to that market. So it is going to, in particular, hit the investors that have that inside information when there's a decline in local property values. This can constrain them in a variety of ways. The decline in collateral values of their existing holdings and the decline of the cash flows behind those can reduce their capacity to invest. That decline in collateral values can also reduce their investor access to funding, in particular if there's perhaps tightening of lending requirements at the same time. And these firms also may wish to just reduce their portfolio concentration in the market that's been impacted. So the argument is that when there is a shock to a given market, the people who all have that inside information have a shock to their collateral that's going to restrict their ability to actually leverage that inside information, to take advantage of those trading opportunities. This in turn then opens the market up to outside investors who, while they lack the informational advantage of the inside investors, they also weren't exposed to the shock to the market. So they may have some dry powder to deploy, and they're taking advantage of a situation where the inside investors who normally have this advantage are being constrained, and that's going to result in a shift in their ability to compete. So what we want to do in this paper, a quick summary of what our goals are and a preview of some of the main findings. We want to document these large movements in sale volumes over the commercial real estate cycle. We want to explore these impediments to the recapitalization of local markets, specifically this trade-off between financial constraints versus informational problems, and how those two things can interact and how that can result in shifts in capital flows into and out of markets. Some of our main findings: one, we do document that this out-of-market investor share increases significantly when in-market collateral values decline. This happens both during boom and bust markets, actually. We also find that out-of-market investors consistently pay less on their purchases, anywhere between 8 to 20 basis points on their cap rate. I want to clarify this very definitely, that we're not calling this a discount. We're not arguing this represents some sort of discount to the true market value that the out-of-market investors are realizing. We are instead argue this is a function of their bidding strategy, the types of properties they target, their attempts to hedge their risks against overpaying, because they know they're at this information disadvantage is being reflected in this differences in the prices that we observe when they successfully transact. Despite this, we also have some evidence that the out-of-market investors, despite their attempts to hedge against this risk, still do overpay for the properties, generating higher returns from the people they are buying the properties from, and then realizing lower returns when they actually sell the properties as well. And the main channel for this lower returns that they realize is this original overpayment. We also see that the out-of-market investors get a smaller premium when they invest in troubled properties. This is, again, we think is all consistent with the information asymmetry story, evidence of the impact of their disadvantage in terms of the information of the properties translating in terms of not just the bidding strategy, but also the returns they receive and the returns they generate for the people they are buying from in the markets. So we have an extraordinarily simple theory section. I actually wrote it, which means it's extremely simple. Just to set up kind of like some basic fundamental arguments about why we think the interaction between collateral and information asymmetry could affect market share. So in this simple model, we have two investors. They're each bidding on a property based on a draw from their expected return on the property. In a simple setup, they have the same mean. So this is in a situation where you have a local bias where inside investors have a higher expected preference, or they anticipate a higher return for local properties, or if there's any persistent bias in the out-of-market investors' tendency to what they think the returns are going to be. The difference is instead in their certainty around this estimate. They have the same expectation, the same central tendency in their expected return, but the out-of-market investor has a lot more higher standard deviation around that, a lot more uncertainty that this is the right value, what the return is going to be. We also impose an upper bound on what the investors can bid based on some common leverage requirements and separate initial levels of initial wealth. This introduces the kind of dry powder argument of it. They pay the same interest rate on their mortgage. They earn the same risk-free rate on alternative investment, and the highest bid purchases the property. So this isn't a dynamic auction. They're not anticipating each other's strategies. It's just a simple portfolio allocation problem. How much of their assets should they allocate to this particular market to buy a property? And it's going to be a function of what they think the property could return, and also how certain they are about that return. And we are imposing leverage requirements as well. So once we solve for this, we can solve for the optimal portfolio allocation. From that back out what we think the optimal price would be for a given property. The key aspects of this solution is, again, the outside investors is at this information disadvantage. This generates a concern about them overpaying. Well, way to think of it is that while the asset is the same property, the actual investment opportunity is different because the uncertainty around that return is going to be different. So in effect, this is a riskier investment for the outside investor, even if the expected return is the same. It's a riskier investment with the same return, they will pay less for it. And that's what we see in this, the solution. And then in fact, the higher the risk to the outside investor, the higher this kind of information uncertainty is around it, the less they're willing to invest in the property. This is one of the things we want to try to testable implications of the model, is that the more uncertainty and the more of a gap in the uncertainty between the inside and outside investors, the more of a gap we'll see in the market share. But we also see that this is a function, in addition, of their initial wealth constraints, that there's a point at which they can't bid higher because of this constraint of the leverage based on their initial wealth. This is a simple simulation using a base case where we are assuming completely arbitrarily a 10% return on the real estate. And as you can see, sigma 1 is the standard deviation for the in-market investor around that return, where sigma 2 but 10% higher, and that's the standard deviation for the out-of-market investor, assuming kind of a constant 1% risk-free rate, 3% interest rate, 70% loan-to-value ratio, and we initially have them start with the same wealth and the same utility measures. This is just a simulation of the various returns of what the bids would be. The red bars are the out-of-market return bids, and the blue are the in-market returns. Two things that leap out from this. One, you see the distribution is skewed lower for the out-of-market investors. This is reflecting the fact that they will hedge their bids because they have more uncertainty around the value, the return on this property. That's going to result in them bidding lower on the same property. That's the result from the model. I think in actuality, what you may see is the out-of-market investors may be more hesitant to engage in bidding wars with a more informed bidder. They may be more willing to just pass if they find themselves with someone who knows the market being more aggressive in bidding up a property. You've seen both of these distributions as well, though, a truncation effect, and that's the effect of the collateral constraints, that there's a limit at which they can't just keep bidding. If we relax that, if we allow them to have no limitation on the loan-to-value ratios, this wouldn't be a truncated distribution. You see that much higher, fatter tail on the right for the in-market bids, with the in-market investors more confident, more willing to bid high, because they have more confidence in their return of their property, but both are truncated. In this particular simulation, we have about 40% market share for the out-of-market investors in this scenario. If we shock the wealth to the in-market investors, W1 declines 10% from 10 to 9. It's just a question of moving that truncation point to the left some more. And that creates kind of a opening now of these draws from their expected return for the property, where the in-market investor can't compete, even if they would like to, with the out-of-market investor because of the shock to their collateral. So this would drives up the out-of-market investor share from 40% to 42%, based on just this 10% shock to the wealth of the in-market investor, using this simple argument. You see a similar shift when we shock the information set for the out-of-market investor. So here we're increasing sigma 2, which is the standard deviation for the out-of-market investor around the return, because they've even more uncertainty, and in particular their disadvantage has increased. This information gap's even higher now. They're more concerned now about the winner's curse and overbidding, so they shift their bids even lower. Here now the market share is again 33% instead of the original 40%. Now, in actuality, in a given market, this may be manifested by the out-of-market investor, even within a market, trying to target properties that they have more certainty about. And this could be changing in types of properties they bid at, perhaps avoiding certain types of properties that have elevated idiosyncratic risk at certain times, which we'll test for when we move to the empirical analysis. When we impose both these shocks, it's kind of interesting. You can see that once you already have this kind of large information shock that hurts the out-of-market investor, if you then shock the wealthy in-market investors, it makes a small benefit. You have a little bit of a sliver here where the out-of-market investor is able to kind of and willing to outbid the in-market investor who's constrained, but there's only a minor shift in the share. I think this is the argument that dry powder is most useful when you can see what you're shooting at. When you have at an even higher information disadvantage, all the dry powder in the world doesn't necessarily help you if you have if you're at a significant disadvantage in terms of the information. We can look at this kind of simultaneously in this particular chart, which is just varying along the left axis, the ratio of wealth for the out-of-market to the in-market investor, and then the information shock or the standard deviation on the return of the out-of-market in-market investor. So that lower corner was 1-to-1. We're roughly about 50% because everyone's the exact same. As we slowly increase the ratio of the out-of-market to the in-market investor, you see they're able to outbid the in-market investor more and more, and their market share increases as we go up this direction. As you increase the uncertainty or the noise or the advantage that the in-market investor has over the out-of-market investor along this way, you see the market share for the out-of-market investor declines. These are the two main implications of this of the theory section, is that we should see this market share increase based on wealth shocks or the relative advantage of the wealth of the out-of-market versus the market investors. And it's also increase in the other direction when you have variations in information asymmetry. With the more of an information advantage the in-market investor has, the less likely the out-of-market investor is going to be to successfully bid against them. So turning to the empirical data, we're using the MSCI RCA data. We use the entire data set, which includes purchases, portfolio transactions, and refinances as well, to help identify our in versus out-of-market definition. But when we do our actual regressions, we're restricting it only to arm's length purchase transactions, and we're using the period from 2001 to 2018. In order to kind of proxy for our shocks to local collateral values, we're merging in county level house prices from CoreLogic as a proxy for those local economic conditions. This is an implicit assumption that the house prices are a good proxy for CRE prices. As a practical matter, this gives us more cross-sectional coverage for the house price indices. We can go down to that county level, which is a little hard to do with CRE price indices. When we actually do the estimations as well, we're we're instrumenting for the impact of the house prices as well, to avoid some of the econometric challenges around that. Now, one of the challenges right up front you want to be engage in is this measurement issue of how do you identify the in versus the out-of-market buyers. This data set is a transaction data set. It has a flow of transactions. It's not a stock of all the commercial real estate properties that all of these investors own. And the data only begins in 2001. So clearly, there's no doubt many properties that were purchased and are being held by investors that predate with transactions prior to that. Looking at the actual data that we see in the holding period statistics, about half of the properties we see turn over at least once. We see about a mean holding period of repeat sales about 5 years, a little shorter if we limited it only to institutional owners instead to 4 years. So we do try to do some, and I'll walk through momentarily how we try to address this in defining our in versus out of market definition. The first and simplest way is using just a purchase data. So if we see a purchase by a buyer with no prior in-market purchases, we define that as an out-of-market purchase. We don't see in the data, they've never bought a property in this market, in this case defined at the county level before, and they show up, they bought a property, they're out of market. If they show up and buy a second property in that market, that second transaction is now in market. So again, the same investor in the same market can have two different transactions, one defined as out of market and one defined as in market. It's only the first time they buy a property in that market is out of market. What we do to augment this, though, is we use not just the purchase transactions, but the previous sales and refis of the investors. So if we observe for a given investor that they've previously sold a property in this market, or refinance their property in this market, we're saying, well, then clearly you are familiar with this market. You are an in-market investor. And then if we subsequently see a purchase, we're defining that purchase as in-market. This allows us to, I think, help somewhat at least mitigate some of the concerns about not observing the stock of all the properties, which you can see with this next chart. The blue line here is what we define as our, over time, our out-of-market share, the share of buyers with no recent in-market transactions, using just the purchases. And as you would expect with a data set that starts in 2001, it's pretty high initially because you only observe the purchases over a couple of years, and then it trends down as the data kind of seasons, and then settles into at a certain point a steady state. When we include our refi and sales activities in our definition of in versus out of market, as you see in the red line, it is better behaved. That helps picking up the impacts of the seasoning earlier in the time period. In both cases, we have the same kind of intertemporal pattern, though, where as the property markets were booming and prices were going up, and these in-market investors actually had a lot of capital they could deploy within their markets. You see in the early in mid 2000s here, you see the out-of-market share kind of declining. Then when the great financial crisis hit, you saw a lot of shocks to property values, which restrained the in-market investors, starved from capital, the people with the inside information. That opened up the door to the out-of-market investors to increase their market shares and come in. Eventually, as the markets kind of healed, we went back to kind of more of a steady state. So this is one way to look at this intertemporal variation that's consistent with this story of how the capital flows into and out of markets. We can also see this in a cross-sectional sense. These are a pair of bin scatter plots where along the x-axis we're graphing the 2-year trailing price appreciation broken out into bins, and along the y-axis the share of buyers that are out of market. And again, we're looking at it over both the boom years on the left from 2001 to 2008, and the bust years from 2009 to 2013 on the right. We see this correlation in both periods. This isn't just a story of during the bust period. It's also during the boom years as well, that the out-of-market investors seem to be more likely to enter and move into markets where there hasn't been a lot of appreciation, where you haven't had where the in-market investors who have the information advantages aren't also sitting on a lot of capital that they can deploy in bidding against the out-of-market investors. They're more likely to target the properties in markets where you've had declines in property values. We can see this drilling into a specific market, and this is looking at Clark County, which is largely the Las Vegas area in Nevada. The blue line in both of these charts is a 4-quarter moving average of the out-of-market share over time, where we have on the left market cap rates in red, and on the right the house price index. In both cases, you see a similar pattern, like in the early 2000s when prices were increasing, cap rates declining. That again benefits the in-market investors because they now have more capital to deploy to support their information advantages, and you see the out-of-market share declining. The crisis hits, collateral values decline. You see this with the house prices. You see this with a little bit more lag with the cap rates. That's in part a function of just not a lot of transactions happening. And the out-of-market investors are able to come in and take advantage of these collateral constraints on the more informed in-market investors, and then the markets return more or less to normal. So these are all like motivating arguments that we have. We want to pivot to a more formal econometric exploration of this now, starting with this linear probability model at the transaction level for if a given transaction, whether the buyer is out of market. Here, what we're going to do to control for test for the impact of this dry powder is looking at local appreciation. Specifically, so we're looking at the variation in the collateral values of the in-market investors and how that's impacting the probability of the out-of-market investors for entering the market. We have a control for if it's a distressed property that's defined by RCA. One thing we have here is that we also include in some specifications, the realized holding period return of the previous owner, which is some interesting results. The age of the property, the central business, if it's in the central business district, use some fixed effects for year in MSA. We also interact the troubled property flag with the boom bust recovery period. And we're doing this in part to try to get at between this and the realized holding period return for the seller. We're hoping to get at some of the issues around the information asymmetry story for these out-of-market investors. Here is the obligatory block of text. That top line here, showing the local appreciation under various specifications, again, is what we're choosing as our primary test for the dry powder part of our hypothesis. That if local appreciation is declining in an area, that's going to constrain the capital available for the in-market investors, and therefore allow the out-of-market investors to win more bids, to have a comparative advantage, to deploy their own capital into the market where their competitors who have the information advantage are restrained. And it's consistent across all of our specifications. So this is consistent with our dry powder argument that when you shock the collateral values of the informed investors, the out-of-market investors are able to take advantage of this and come in. You also see that the out-of-market investors are more likely to come in and target troubled properties. With that second line there is consistent, fairly and positive across most of our specifications. One thing that is interesting is, however, that when we interact that troubled property dummy with the bust dummy, it's actually significant and negative, taking away most, if not all, of that impact. The way we interpret this is that if you're thinking about picking up a troubled property, there's always a certain degree of information asymmetry. If something's wrong with the property clearly, or it wouldn't be troubled. An outside investor may be more comfortable doing that if, well, the property is troubled, the market's doing fine as a whole, because the argument is all we need to do is change the management, do some CapEx, and get the market rates. We great investment. However, buying troubled property during a bust, there's a lot more, I think, uncertainty around the future return to that property. Perhaps even some uncertainty around the macro path of the economy and that particular market as well. So we argue that this pattern here is, again, a function of this information asymmetry, that the out-of-market investors are less likely to target properties where there is more information asymmetry. So you don't want to go bottom fishing in a storm, would be the argument. There's just more risk there. Again, we also include this prior holding period return. This is the holding period return to the seller. So we have fewer property transactions because we need to see the previous purchase to calculate that. But we do see a significant and positive sign here, which suggests that these out-of-market investors are more likely to generate positive holding period returns to the sellers. And this could be a function of them overpaying, which is consistent, I think, with some of the arguments in the literature. It could also perhaps be that maybe they just target higher quality properties with longer long-term returns. Would be one argument. You can probably tell from my tone of my voice, I don't buy that second argument, and we do some actual explicit tests later looking at the subsequent holding period returns to try to test that hypothesis. But we argue that this is largely indicative of this tendency to overpay, which is another part of this information asymmetry story. So to summarize, the out-of-market entry increases when local property prices decline. This is our dry powder story. But the out-of-market investors are more likely to target troubled properties only really during a recovery and less likely to target during the bust. We think this is consistent with the inside information part of the story. And we argue this holding period return for the sellers being higher when there's an out-of-market buyer is also consistent with information asymmetry and is evidence of an overpayment effect. So now we're going to pivot to, now that we've looked at the entry model, this is the pricing part of the model. How much do the out-of-market investors pay for the properties? This is a distribution of the cap rates for the out-of-market buyers in red and the in-market buyers in green. So when we talk about how the out-of-market buyers pay less for the properties, this is what we're talking about, that they have the distribution of a higher cap rates for the out-of-market investors. And we want to now, in the next model, explore that more formally to figure out what's perhaps driving this tendency for the out-of-market buyers to pay less for the properties. Again, the top line here is our out-of-market buyer indicator. This is significant and positive across all our specifications. This is why we argue that the out-of-market buyers pay less, between 9 and 20 basis points on the property. You also see that there's again, we're not calling that a discount. We view that's more perhaps a function of the kinds of properties they target that we can't all control entirely with our controls, and their bidding strategies. We are comfortable calling the impact of the troubled property a discount, that the property is troubled. There is a discount of around 20-25 basis points for troubled properties. And we also find that there is a discount for investing in troubled markets, where you see the local appreciation line, which is significant and negative. So if you're buying a troubled property, you're buying it at a discount. If you're buying a property in a market where the property prices are on a whole declining, you're also paying less as well. However, what's interesting is that both of those effects, both at the property level and the market level, don't seem statistically significantly different for out-of-market investors. So while there's discounts for troubled properties and market level effects as well, those don't seem significantly different for our out-of-market investors. We also have the prior holding period return here. I'm not going to talk too much about that. We view that, I mean, by definition, this should be almost mathematically negatively correlated with the cap rate. If you have a lower cap rate, there's a good chance you're generating a higher holding period return for the person you purchased the property from. We wanted to include that here mostly as a control to get kind of a better feel of the results of the other out-of-market buyer indicators. So again, just a quick summary for the cap rate regression. The out-of-market buyers consistently pay less for the properties, from 8 to 20 basis points. This is consistent with this bidding strategy coming out of the model, that they're either going to try to bid less because they're worried about overbidding more. You'll also see troubled properties trading at a discount, and counties where you see significant appreciation trading at a premium, but this effect seems to be the same for both in and out of market investors. And again, this holding period return has the expected relationship with the cap rate, but this allows us to control for that effect for the other factors. So now let's pivot to when they sell the properties, which again, the fact that they're selling the property isn't necessarily a random event. They could be holding the properties as well. And we're not seeing this is only the capital returns we're measuring here. We're not taking into account necessarily the cash flows they generate during the holding period. But again, we see that there is a variation between the out-of-market and in-market investors. The out-of-market again in red, in-market in green. And not quite as significant as we saw in the cap rate distribution, but we do see lower returns for out-of-market buyers. This is consistent with the idea that there's a return to information, that the in-market investors that have greater return are able to then translate that into higher realized returns when they buy and sell properties. However, when we throw this in and do the regression, once we control for this tendency to overpay as measured by the prior holding period return, which comes up significant and negative, once you control for that, the actual out-of-buyer effect is statistically significant and positive, but fairly minuscule. I would argue it's not necessarily economically significant. So the argument is that a lot of this variation we see in the unconditional distribution for the holding period return is being driven by this tendency of the out-of-market investors to overpay. This also addresses the argument that I mentioned earlier, that was this prior holding period return for the generated for the seller reflective of overpaying or reflective of this kind of like a persistent quality effect of the properties. If it was a persistent quality effect, these are always properties that just tend to generate higher returns, this coefficient would be positive. It's negative, so this is much more supportive of this overpayment story that we hypothesized earlier. One thing of interest, though, is that once we interact that with the out-of-market investor, that interaction isn't significant. So while the out-of-market investors are more likely to overpay, when they do overpay, they don't overpay any more so than the in-market investors. We also see there's a premium for buying and flipping a couple property, about 1 to 2%. Interestingly enough, that premium is less for the out-of-market investors. It's significantly less than when the out-of-market investor has purchased the triple property. We again argue this is consistent with the information story, that buying a triple market property, if you know more about the market, you're better able to actually price that and then realize the return for doing that. Here's something that's no doubt not much of a shock. If you bought a property during the boom years, you get a negative return, and then higher returns if you bought properties during the bust and recovery years, which again shouldn't be a massive surprise to anybody. That's highly consistent. So again, a quick summary of looking at what drove the holding period returns. Holding period return to the previous seller is negatively correlated with the holding period return to the buyer when they sell the property. Again, evidence of an overpayment effect. While out-of-market buyers are more susceptible to this, the internal margin of overpayment doesn't seem to be different for them. You see a premium for selling triple properties. However, that is lower for the out-of-market buyers, which is again consistent with the information asymmetry story. Once you control for all this, you do have a statistically significant but minuscule higher return for out-of-market buyers after controlling for this overpayment effect. And again, we're not controlling for necessarily differences in the cash flow, and it could also be, if you're looking at leverage returns, differences in terms of cost of funding as well, which we didn't have in our initial model. And again, buying a property in a fire sale market or during the bust generates a high, or the recovery generates higher returns. So I'm going to quickly go through, I'm not going to go through the individual tables, some of our robustness checks. The first was we repeat all of our specifications. It's now limiting our analysis only to investors that we have observed at least 50 or more transactions in our data. So the argument is that these are the larger, more professionally managed firms. They can tap more expertise across it, and we repeat our analysis for the market entry regressions, our cap rate regressions, and our holding period return, and I'll summarize all those results in a moment. We also regress the log of the price per square foot as opposed to the cap rate as an alternative with our initial sample, as an alternative to our cap rate model. Turning to the results, when we look at the differences of the sample of the larger firms, the impacted dry powder and the incentives to target triple properties are roughly the same. We do see a little bit of a less propensity to overpay, and more of a fire sale discount for the larger firms, which is perhaps consistent. Perhaps they are, as a larger, more professionally managed firms, they can tap more human capital to kind of mitigate some of this information asymmetry story. When we do the results for the price per square foot regression, the results are less robust than when you do it with the cap rates. However, we still see on our preferred specification lower prices for out-of-market buyers. We also, in doing this result, the out-of-market buyers will pay even less for triple properties. One other set of robustness results, which we are pending at the moment, is to replicate this at the CBSA level as opposed to the county level, and see if our results still hold up there as well. So I'm going to do the quick review of the findings, and I'll be more than happy to engage in some discussion with everybody. Although I'm sure John's been answering all of the comments in the chat with far more accuracy than I could. One of the key things we want to do with this paper is document this important role of out-of-market investors as a source of stability for weakened markets, and how this shifts of capital flow across regions can help markets that are in free fall find the floor as the capital comes in. We think this is evidence of the impact of financial constraints, and that the reason the out-of-market investors can do this, and are allowed to increase their share, is that this is at a time when the local investors who have the information advantage are constrained. So they're fighting with one hand tied behind their backs. This gives the edge to the out-of-market investors with the dry powder. They can come in and win bids when they normally, in normal situation, would have been outbid by the in-market investors. But we also find extensive evidence of the information asymmetries. Our argument is that this lower higher cap rate, the lower price for the out-of-market investors, is being driven primarily by this bidding strategy. That they're trying to avoid the winner's curse because they've internalized the risks they have of the information asymmetry. We still find that despite their attempts to do this, there's still evidence they're able to overpay when they purchase properties, and then get lower. That drives lower returns when they sell the properties. We also see that they get less of the triple property premium, which I think this is the fact that the in-market investors get higher returns in triple properties. We think is another evidence of this higher return on the information effect, that they're able to better and more accurately bottom fish, because they know the markets better than the out-of-market investors when they come in. I'm going to go ahead and stop sharing my screen so I can actually see the various comments that have been coming in. So, although I'll be happy to go back to any particular slide in response to a question.
Yeah, why don't we open up to anyone with any questions I'd like to ask?
David, this is John Craner. I was just wondering if I could summarize some of the questions that came in the chat. Thanks everyone for a really active session. So Joe, I've got a copy of everything, so we can look through together. But there are really two things that really stood out. One was on the definition of the out-of-market investor and what that may or may not be capturing, and so I think some of our robustness tests and future plans for robustness tests can get at that. That definition is definitely important in this paper. As Joe was saying, David Ling has a paper touching on some similar issues and gets slightly different results with a different definition of out-of-market investor. The other issue that really stood out was about in and out of market investors might have different ability to time the market in terms of renovations and resales, and a lot of people jumped on that. So Chris Mayer was the one who initially asked that question. Chris, I don't know if you're still on, but do you want to put that on the table?
Sure. Can you hear me?
Yes.
So I would I would go kind of a little bit further in the sense of saying one of the challenges of not observing quality in CapEx is it's hard to calculate things like overpayment and returns. So you can imagine local investors have a strategy of buying stuff that needs more capital improvements, for example, and that may explain some portion of the results, and also in particular the financial results. That is, what they appear to get a higher return, or they appear to be paying, a better price, but it may be that they're buying properties that they're putting in a lot of CapEx, for example. And so you can imagine differentiating the kinds of strategies and the kinds of things they're doing, which just makes it hard to sort of think about this. I mean, it's a general problem in all of the kinds of, when you're sort of arguing that certain investors have advantages, and it differentiates the literature on equities, for example, where you don't have a CapEx issue when you're looking at stock market returns and buying shares of companies that are, home country, out of country returns. So I throw that as a kind of a general observation, because I can imagine other sorts of things, differences in strategy that would show up here. I have a paper, part of this comes up to a paper with Alex Chinko that we looked at local and out of town investors in Las Vegas in the last boom in the housing market. We had some of the same issue. One of the things we used to differentiate that was to look at the timing of the sales. That is, we found local investors tended to be better at flipping than out of town investors, which is they tended to sell at points in the market where prices were highest. And so that was a way of getting around the problem at least a little bit, because it appeared to reflect knowledge of the state of the market that was different for local than for out of town investors. So it was a way of determining something about information specifically. But I think it's hard to, if you don't observe the actual return and the CapEx that people put in, it's very difficult to argue that somebody overpaid or underpaid or earned a better or worse return just by looking at the two endpoints.
I agree completely with the comment. I'm wondering if there's one way to leverage differences and changes between price per square foot between two transactions versus the cap rates between two transactions. Because if you're assuming that, like if you renovate a property and that's going to raise the potential rent you can generate from the property, that would increase the price per square foot, but that may not necessarily have an impact on the cap rate. I'm wondering that might be some way to use that as a way to get into that differentiation.
I mean, it's hard with lease structure and other things to, what are they trying to calculate? Commercial properties are even tougher than housing in that context, because you have embedded leases and things, which you can't see when they're, rolling over a lease at a particular time. So it's an important question, but it's a tough problem to work through, but there may be something there.
Yeah.
There have been two great questions in the chat since the presentation ended. So I just want to make sure that you all have a chance to respond. So first, Michael Giliberto asked, did you detect any differences in results for different investor types, i.e. large investment manager versus private family wealth?
We haven't looked at that explicitly. I know we have that robustness check where we're limiting it to larger investors. I think that's a question that's come up a couple times that I think would be useful to explore perhaps in more detail. We do have some information as to both how RCA defines the various investors, and we could probably do some additional work as well, perhaps trying to pull in, especially for the large REITs, some external sources of data on their overall portfolio and holdings, which may be useful.
Well, one of the reasons I ask is that, these different investor types could have different costs of capital and different return needs in order to satisfy the role that real estate's playing in their portfolio. So it's at least worth taking a look if there's differentiation there.
Yeah, that some of this differences we're seeing may be addressed with, if you look at the leverage returns, if there's differences in cost of capital that could be causing that. I think that's an excellent point.
And Tony Yeaser had a question. Could it be that out-of-market investors are better equipped to diversify away the idiosyncratic risk in the local markets?
I think that's actually like part of the argument that the out-of-market investors, because they're able to tap other sources of funding, and again, this could be their portfolios in other markets, or it could be someone like a sovereign wealth fund that has an inflection of capital from an entirely different part of the world to help address that. And I guess part of that would be then to think about one way to perhaps get at this is, we don't have the entirety of the holdings of the properties, we can basically retroactively create kind of portfolios of the holdings based on the RCA data. So it's not going to be a complete picture, but we'll see their portfolio of every property they bought since 2001. So it may be from that, it may be interesting to then look at the distribution of holding period returns based on how geographically concentrated investors are, to like compare investors that are concentrated in single markets versus ones that are present in multiple markets, and how that affects their overall distribution of their realized capital returns when they sell properties. Would be perhaps one way to kind of get at that. But yeah, I think that's something we discussed is another approach from this is, instead of looking at it from the individual property transactions up, look at it more as the decision of the investors to expand to new markets and what's driving that and how that's driving their overall portfolio return. So I suspect that probably doesn't fully satisfy Tony, which won't be the first time I've been unable to completely satisfy one of his questions.
David, I had a question. Yeah. Is it okay if I ask it out
Yeah,
loud?
of course.
Okay. So, great paper, Joseph. Thanks so much for the presentation. So in explaining the drivers of market entry, you mentioned that, the out-of-market entry increases, which is associated with an exit of the incumbents or insiders because of the negative capital shock or wealth shock. Since you observe the out-of-market investors' transactions in their own, markets where they are insiders, can you actually look at whether they received a positive wealth shock to kind of look at the other side of the mechanism here?
Yeah, we've actually, I think in some earlier versions of the paper, experimented with that to try to calculate a portfolio weighted kind of like what was the weighted by the properties we know that they hold, what is the weighted house price increase in those counties would be one way to look at that. And I think we found results that were largely kind of consistent, but there's also the issue of that we know we don't have the entire portfolio based on the measurements of the data. So I think that's definitely something we've considered exploring, but there's pros and cons. I think the other aspect that we haven't explored is geographical variation in their financing as well. That could they be tapping national markets for the financing of this? And there is, especially in the earlier data, there's less detail about the financing in this data set. More recently, there is some more. And actually, one comment to, I think, Thomas Davidoff's comment about teardowns. We don't have teardowns, but at least in the more recent years of the MSCI RCA data, they've also included in that data set new build data. They take the data from the Dodge contracts data and then add some additional information and link it with their the rest of the transaction data. Those aren't necessarily knockdowns and rebuilds, but there clearly are new commercial real estate being built in the market, which may be a way to kind of get at, I think, some of the questions that Tom had. And I don't know if Jim Costello's online, but I am trying to say MSCI RCA, not just RCA. As you can see, we still have to update the slide deck to have that.
Any last questions? Okay, well, I'd love to thank Joe and John for coming today and presenting a really great, interesting, thought-provoking paper. I want to thank the audience for coming and for generating some really great discussion. I think Joe and John got some really excellent feedback.
Yep.
So I hope you can all join us in 2 weeks for our next seminar on February 1st, which will be the economic vote, evidence from interest rate pass-through. Ben McCartney will be presenting that. And you can look for a recording of this seminar on the Aurora website, hopefully in a couple of weeks. Thank you all again. Appreciate it.
Thanks.
Thank you so much.
Thanks, everyone.
Thanks for organizing it, Dave.
Thanks, Joe. Take care.